When we talk about being unbanked, we are talking about people who do not have a traditional bank account. This means they do not have a checking account or a savings account at a bank or a credit union. Imagine trying to manage your money without a safe place to keep it. Instead of depositing a paycheck, these individuals must find other ways to cash their checks. They often use check cashing stores, which can charge very high fees for their services. This is a reality for millions of people, and it makes their financial lives much more difficult and expensive than they need to be. It is important to understand the difference between being unbanked and being underbanked. An unbanked person has no connection to the banking system at all. On the other hand, an underbanked person does have a bank account, like a checking or savings account, but they do not use it for all their financial needs. They might still rely on alternative financial services. For example, they might have a bank account to receive their paycheck through direct deposit, but then go to a payday lender for a short-term loan instead of using a bank's credit options. This shows they are not fully integrated into the financial system. Let's look at a clear example to see the difference. An unbanked person might get paid with a paper check and take it to a check cashing place, paying a percentage of their earnings just to get their money. An underbanked person might have their paycheck directly deposited into their bank account, but when they need to pay a bill, they might buy a money order instead of using a debit card or online bill pay. Both situations create extra costs and obstacles, but the unbanked individual is completely outside the system, while the underbanked person is only partially in it. Living without a bank account means missing out on many benefits that most of us take for granted. You cannot build a credit history, which is essential for getting a loan for a car or a house. You do not earn interest on your savings, so your money is not growing over time. There is also a greater risk of theft when you keep large amounts of cash at home. Being unbanked is not just an inconvenience, it is a significant barrier to building wealth and achieving financial stability for yourself and your family. It keeps people trapped in a cycle of financial struggle. So why do people choose to live without a bank account? The Federal Deposit Insurance Corporation, or FDIC, has studied this question and found several key reasons. One of the most common reasons is that people feel they do not have enough money to meet the minimum balance requirements. Many bank accounts require you to keep a certain amount of money in them to avoid monthly service fees. For someone living paycheck to paycheck, the fear of not being able to meet that minimum and getting hit with fees is a major deterrent. They feel it is safer to manage their cash themselves than to risk losing it to bank charges. Another significant reason people stay away from banks is a desire for privacy. Some individuals are simply not comfortable sharing their personal and financial information with a large institution. They may worry about how their data is being used or who has access to it. This concern can be especially strong among immigrant communities or people who have had negative experiences with official institutions in the past. For them, keeping their financial matters private is more important than the convenience a bank might offer. They prefer the anonymity of using cash for their transactions, even if it comes with its own set of challenges and risks. Finally, a deep-seated mistrust of banks keeps many people away. This lack of trust can come from personal experience, such as a past issue with unexpected fees or poor customer service. It can also stem from what they have heard from family and friends or seen in the news, especially stories about banking scandals or financial crises. When you do not trust an institution to handle your money fairly and honestly, it is natural to want to avoid it altogether. This mistrust is a powerful barrier, creating a feeling that banks are not there to help them but rather to profit from their financial vulnerability. These three reasons, not enough money, privacy concerns, and lack of trust, often work together. A person might feel they do not have enough money, which makes them wary of fees, and this wariness can grow into a general mistrust of the banking system. They may see banks as institutions designed for wealthy people, not for someone like them. Understanding these reasons is the first step toward finding solutions that can help people feel more comfortable and confident about joining the formal financial system. It is not about forcing people to use banks, but about removing the barriers that prevent them from doing so. When we look at who is most likely to be unbanked, the data shows clear patterns. According to the FDIC, about 4.5% of households in the United States were unbanked in 2021. That translates to approximately 5.9 million households. While that number has been decreasing over the years, it still represents a significant portion of the population that is left out of the mainstream financial system. These are not just statistics. These are families and individuals who face daily challenges in managing their money safely and efficiently. The impact is felt in communities across the country, affecting people from all walks of life. Certain demographic groups are more likely to be unbanked than others. The FDIC report highlights that unbanked rates are higher among lower-income households, less educated households, and younger households. Race and ethnicity also play a significant role. For instance, Black and Hispanic households have historically had much higher unbanked rates compared to white and Asian households. In 2021, the unbanked rate for Black households was 11.3%, and for Hispanic households it was 9.3%. These disparities show that being unbanked is often linked to broader issues of economic inequality and systemic barriers. The reasons for these disparities are complex. For many minority communities, historical discrimination in banking and lending has created a lasting legacy of mistrust. This is combined with the fact that these same communities often face greater economic challenges, such as lower average incomes and less generational wealth, making it harder to meet minimum balance requirements. The lack of physical bank branches in some low-income or rural neighborhoods, often called bank deserts, also makes it physically difficult for people to access banking services, further pushing them toward more expensive alternatives like check cashing stores. Understanding who is unbanked helps us see that this is not just an individual problem, but a community-wide issue. When a large number of people in a neighborhood are unbanked, it affects the local economy. Money leaves the community through high fees paid to alternative financial services instead of being saved or invested locally. This creates a cycle where financial instability is passed down from one generation to the next. Breaking this cycle requires targeted efforts that address the specific needs and concerns of the communities that are most affected by this financial exclusion. The good news is that there are many efforts underway to help unbanked people access the financial system if they choose to. One of the most promising developments is the creation of bank-on certified accounts. These are low-cost, low-risk checking accounts designed specifically for people who are new to banking. These accounts typically have no overdraft fees, low or no monthly maintenance fees, and low minimum opening deposit requirements. Many banks and credit unions across the country now offer these accounts, providing a safe and affordable entry point into the world of banking for those who were previously excluded. Financial technology, or fintech, is also playing a huge role in increasing financial inclusion. Mobile banking apps have made it possible to manage your money without ever stepping foot into a physical bank branch. This is especially helpful for people who live in bank deserts or have transportation challenges. Many fintech companies offer user-friendly apps that provide basic banking services, budgeting tools, and even ways to build credit. These digital tools are breaking down traditional barriers and making financial services more accessible and convenient for a wider range of people, empowering them to take control of their finances from their smartphones. Community-based programs and financial literacy education are also critical pieces of the puzzle. Local nonprofits, credit unions, and community development financial institutions, or CDFIs, often work directly with unbanked populations. They offer workshops on how to open and manage a bank account, how to build credit, and how to avoid predatory lenders. By providing trusted one-on-one guidance, these organizations help build the confidence and knowledge that people need to navigate the banking system successfully. This personal touch is essential for overcoming the deep-seated mistrust that many unbanked individuals feel. Ultimately, the goal is to create a more inclusive financial system where everyone has the opportunity to build a secure financial future. Progress is being made, and the number of unbanked households is slowly but surely declining. By continuing to support initiatives like bank-on accounts, embracing innovative financial technology, and investing in community-based education, we can continue to open doors for more people. Helping individuals and families join the banking system is not just about giving them an account, it is about giving them access to the tools they need to save, invest, and achieve their dreams.